Good morning and good afternoon and good early morning as well. My name is Todd Rosenbluth from CFRA, and thanks for joining us for using momentum strategies to find the outperformers in the Nasdaq-100, a CFRA webinar that we're doing with ProShares. We'll move to the next slide if we can, just to give you some perspective on who the speakers are joining me. I've got Jay Gragnani, who's the head of research and client engagement at Nasdaq Dorsey Wright, and Kieran Kirwan, who is the director and senior investment strategist at ProShares. Excited to have them both here. We'll move to the next slide, which is going to get you involved in the overall conversation. We'll bring a poll up, I believe, to get a sense of where we are and the audience, if we can pull that up. Now that we're in the second half of 2021, what in the market concerns you most? And we'd encourage you to select all of these that apply. A slow economic recovery, the modest return potential, market volatility, missing out on opportunities, or rising interest rates. Again, please select all of those that apply. I'll take a pause for a second, and then we'll see the results of the poll, which will help us better talk through the conversation. So let's bring the results up if we can. And we can see here market volatility actually is pretty well split, but market volatility and then rising interest rates and a modest return potential. So we're going to cover market volatility, and we're going to cover just how you can find opportunities to find upside potential throughout the presentation. So let me just walk you through who CFRA is and how our ETF research that we're going to talk about fits in well with the stock research that you're probably familiar with. We do a holdings-based approach. We have sector and industry research, a top-down view from our investment strategist, Sam Stovall, and our ETF research sits above our individual company research. And we've been doing this for years, covering a broad array of individual companies. We'll move to the next slide if we can. And we'll see just how CFRA does that. So we combine our fundamental and our forensic research to offer a more forward-looking assessment of ETFs. We're going to touch on one of ProShares ETFs that launched in 2021 that we're already covering, in part based on our coverage of the underlying holdings, and then how that fits in with performance analysis and more traditional risk metrics and cost factors. So we're ending a blended approach to offer a star rating across over 1,800 ETFs and separately tens of thousands of mutual funds. Move one more slide if we can, that even though we're partnering with ProShares and they're partnering with Nasdaq to talk about this, we're independent. We have no conflicts of interest. We don't make money through managing assets. We don't, in fact, cover ETFs that track an index that CFRA is part of. What you get is a truly unbiased star rating with our research and our qualitative assessments of it. I've got one more slide on the next one if I can, because this is a bit stale. We actually are at the record-breaking point for ETF inflows in 2021. We're at $500 billion of net new money. 504 went in all of 2020, and we probably have even more. We're a day behind in the flows as of the weekend. And you can see tremendous growth both out of equity and fixed income ETFs. Fixed income ETFs are on pace to match the level. Equity ETFs have more than passed that and are likely to double what we saw for all of 2020. And that's in part based on investor optimism in the stock market and in part based on really impressive new products that have come about. So I want to talk about one of those products that came to market in 2021. I'll move us forward to the next slide and bring Jay back, or introduce Jay again into the conversation, and let Jay talk about something interesting that they're doing at Dorsey Wright Nasdaq about a momentum index. Jay, thanks for joining me.
Todd, thank you so much for having me on, and appreciate the time and the opportunity to talk about the Dorsey Wright Nasdaq-100 Momentum Index. This is a strategy that we have worked on and put together and launched an index back in March of this year that really was designed to take the Nasdaq-100 as the base universe, as the starting universe, and apply a methodology to it that is designed to identify the leaders within that index from a relative strength or momentum perspective. And so what we wanted to do for the next few minutes is walk through the methodology of the index, how we look at that index, how we measure momentum. I know momentum is a word that gets thrown around quite a bit, and I wanted to spend some time talking about very specifically how we measure and how we identify momentum stocks, high momentum stocks, and how we also systematically identify when those high momentum stocks are no longer in high momentum or no longer in the portfolio. So with that said, if we could go to the next slide for a minute. And when we talk about momentum or we talk about relative strength, for us, it's nothing more than a ranking system. And if we think about it conceptually for a minute, you think about sports and whatever sport it might be, and you know, whether it's football, baseball, basketball, hockey, golf, we've got the Olympics going on right now. You could pick any one of those sports. The whole idea with that is, in order for a team or an athlete to move up the rankings in their respective sport, they have to show the ability to perform on the field. It's not the potential that they have, but it's the ability to actually perform. And so if we think about something like the 400-meter freestyle swim as part of the Olympics, well, the only way athletes make it to the Olympics to represent their respective countries is they have to go through a process of qualifying. The process of qualifying is winning the heats and winning against all of the other athletes that are competing because they are the fastest to get to the finish line. Well, that idea right there is momentum. That is relative strength. That is taking the athletes that have shown the ability to perform, and we're going to take those to the Olympics because those are the athletes that have the most potential, most likelihood to perform in the future and perform against the best of the rest of the world. Well, the stock market, we look at it in a very similar manner. Those stocks that have shown the ability to outperform are also ones that have shown the ability to outperform over time. And there's a lot of research, a lot of academic research, a lot of actual research that has been done around that. And the way that we quantify which stocks are showing the potential to outperform is through a simple relative strength calculation that is then viewed through a point and figure relative. And so the point and figure methodology is just a form of technical analysis. And it's a form of technical analysis that we utilize to identify those relative strength leaders. So very simply what we do is we take the price of a stock, we divide it by an index, we multiply that number by 100, and we get a reading. This calculation is something that you and we could all sit down and do by hand. I know for a fact we can do it by hand because when I started at Dorsey Wright as an intern, I was forced to do these relative strength calculations by hand on a number of stocks every single day. But at the end of the day, that reading, that relative strength reading in and of itself is not so important. It's when we take that reading and put it onto a relative strength chart that brings it to life and brings meaning to it. So if we go look at an example on the next slide, we could look at how this calculation actually plays out in the real world. And so what we're looking at here is a relative strength chart of Applied Materials, a member of the Nasdaq-100, versus Microsoft, another member of the Nasdaq-100. So we take every single night, we take the closing price of Applied Materials divided by the closing price of Microsoft, multiply that value by 100, and then simply use that value to plot that onto a point and figure relative strength chart. If you're not familiar with point and figure charts, column of X's represents that value is moving higher. A column of O's represents that the value is moving lower, such that as Applied Materials is outperforming Microsoft, this chart is going to move higher in a column of X's. If Microsoft begins to outperform Applied Materials, then you'll see the chart move over to the right one column and begin to move lower in a column of both. So what we're looking at here is not a pure price movement of any one security, but it's a ratio. It's a relative performance of Applied Materials versus Microsoft. At the end of the day, what we want to do is identify trends and outperformance. And the way that we define that on a relative strength chart is by a buy or a sell signal. A buy signal is very simply defined as a column of X's that exceeds or moves one box above the previous column of X's on the chart. So for instance, if we look down there at the bottom where that orange circle is, Applied Materials gave a relative strength buy signal against Microsoft in June 4th of 2020. Now, again, all we're looking at here is the price of those stocks. We're not looking at anything else. We're just purely looking at the price movement, price action of those stocks by that daily calculation, dividing Microsoft by Applied Materials. And then that chart gives a relative strength buy signal. What that suggests is that Applied Materials is likely to continue to outperform Microsoft. And for about a year, this chart has a relative strength buy signal. Now, over that time period, everything's up. The Nasdaq-100 was up about 47%. Microsoft was up about 42%. However, Applied Materials is up 139% over that same time period. And that's really what we're looking at with relative strength, is trying to identify those stocks that have the potential to outperform another stock or other stocks within the inventory. Now, in this instance that we're looking at here, the direction of the move of all of the stocks was positive, but the magnitude of the move of Applied Materials in this example was much greater than that of Microsoft, despite Microsoft being the second largest company, second largest weight within the Nasdaq-100 index, based on market capitalization. What we're looking at is the price performance of the security there. So that's just one example, but I wanted to spend a couple minutes on that, because that is really what is going on behind the scenes of the Dorsey Wright Nasdaq-100 index. Instead of looking at one stock versus the other, if we go to the next slide, we look at each stock in the Nasdaq-100 versus every other stock within there. So we're comparing Microsoft to Applied Materials. We compare Microsoft to Moderna. We compare Microsoft to Intuit. We compare Microsoft to on and on until we take all 100 stocks in there, and each of those stocks is compared versus one another. What that allows us to do is then go and say, how many relative strength buy signals does each stock have versus every other? So essentially what happens is we have a big arm wrestling tournament, or going back to our analogy of swimming, each stock is competing against every other stock. So at the end of the day, there's nearly 10,000 relative strength charts that get created to come up with these rankings. And then what we can do is rank these stocks based on the number of wins or the number of buy signals that each stock has. So right now, Biogen is on a relative strength buy signal against 99 out of the other 99 stocks in the universe. In other words, it's on a relative strength buy signal against every other stock that it's being compared against. So it's given the number one seed or the number one rank within our matrix. Moderna is at number 2 at 98 buy signals. NVIDIA is number 3 at 91, Alexion 90, so on and so forth. And so what this does, this relative strength ranking then allows us to identify which stocks are the strongest from a relative strength perspective. That is, those that have the most relative strength buy signals or most wins within the respective tournament that they're playing in, and also which stocks are the weaker names within the universe from a relative strength or from a momentum perspective. And so the idea when we're looking at this relative strength matrix is those stocks that are at the top of the list, names that have more relative strength buy signals, those are the ones that have shown the ability to outperform the other stocks within the universe. Those are thus the names that are deemed strongest from a relative strength perspective, and those are the names that we want to put into the index as those are the ones that have the greatest potential to outperform going forward. Very similar to the example that we talked about earlier with Olympics and selecting our team for the who's going to go to the Olympics. It's based purely on the performance of the athletes at that time, and that's exactly what we want to do. We want to base our decisions of which stocks go into the index based on what they've done on the field. And so with that said, if we go to the next slide, I say base our decisions. It's important to know that the portfolio, the index, is very much systematic and rules-based. There's no objective investment decisions that are being made in terms of how the stocks go in or when they come out. It's very much systematic and rules-based. And so what we do is once we establish our 100 stock ranking through that relative strength matrix, we simply own 21 out of the Nasdaq-100 stocks. So we're buying about 20% of the strongest names within the Nasdaq-100, and we evaluate that on a quarterly basis. So we're going to buy the top 21 stocks within the rankings, and then we're going to come back once a quarter, and we're going to evaluate those rankings. And if those names continue to rank within the top half, they're going to stay in the index. If they fall out of the top half of the rankings, they're going to be sold and replaced with the next highest ranking stock that's not already a member of the index. And so again, that process, the evaluation process is done on a quarterly basis, and very specifically, it's done on the third Friday of January, April, July, and October. So with that said, it was just recently done about a week ago. We saw the index undergo its quarterly evaluation, its quarterly reconstitution, and then when it happens, each of those 21 names gets rebalanced back to an equal weighted position. So that's the rules of the index. If we go to the next slide, we can see the net result of what we saw come out of the most recently quarterly evaluation process. Here's the 21 stocks that are in the index, and certainly there's names in there that we all recognize as the Facebooks and Alphabets of the world that are in there. But we've also seen, with the most recently quarterly edition, I think the biggest theme that we saw this time around during this evaluation was a rather notable increase in healthcare, specifically from some of the names like Moderna and Biogen moving into the index, and removing some technology names that were part of the portfolio. So technology still is the largest sector weight within the index right now at about 42%. Healthcare is a very notable overweight as well at nearly 25% of the index. And so again, that is the simple rule, the methodology, the process of how this index was constructed and put together, is again very simply designed to identify 21 of the strongest relative strength or strongest momentum names out of an inventory of the Nasdaq-100, which is an inventory that consists of 100 of the largest, most innovative companies in the world. And what we're trying to do is take that inventory and then identify which 21 of those stocks have the greatest potential to outperform over time. So with that, Todd, I will turn the call back over to you and go from there.
Thanks, Shay. I want to highlight a couple of things on here and connect it to the way that CFRA covers the ETF, in part based on what's inside the portfolio. So I want to highlight, there's some stocks in the technology sector like ASML Holdings and Broadcom that are towards the top of the list alphabetically. That makes it easier for me. Those are buy and strong buy recommended stocks, as of course is Alphabet. I want to also highlight, people tend to think of the Nasdaq-100, which is of course what this is based on, as a technology index, and it of course never was. There's exposure to other sectors, but this I think drills it home quite sharply that it's not just, but 42% of the portfolio is technology, and you got a healthy exposure to, pun unintended, of healthcare and consumer discretionary and communication services, and even industrials. People probably are less familiar with exposure there. So maybe you want to just comment on, it's not intended sector diversification, but what you see when you look at this from a sector perspective?
Sure. Yeah, you're absolutely right. I mean, the Nasdaq-100 index at large, it is certainly a tech-heavy, but not tech-only index. And what's interesting when you look at the way that the Dorsey Wright Momentum Nasdaq-100 index is constructed, it's constructed in a way that is not sector aware, meaning the index is going to identify the strongest stocks, and the sector weightings become a byproduct of the strength across the stocks there. And so, if the strength is, within technology, you'll certainly see an overweight towards technology. I think within the Nasdaq-100, it's about right now today about 6% technology. And so while we have 42% technology in this index, it would be relatively underweight. The healthcare it would be the overweighted part, but certainly given a lot of the work that we've done, we could see meaningful sector differences within there. If some of the big cap tech names and do rotate out of favor, at the same time, it's got the ability, if technology is a sector that is performing well, if those stocks are performing well, has the ability to get up to market weight, if you will, relative to the Nasdaq-100 index.
Thanks, Jay. I'm going to move us forward to the next slide, which I believe we're going to do a poll. We're going to do a second poll of the audience for them to share their thoughts. And then I'll bring in my colleague from ProShares to help us understand the output that you're sharing with us. When considering growth investing, what are the features that are most important to you? And again, please select all that apply. Strong outperformance, low volatility, a rules-based strategy, and consistent sector and style consistency. I'll leave the poll up for a second to just take the opportunity to say, now would be a good time after you do the poll results. If you have questions, we'll take as many of the questions that come in as are appropriate. There's a chat function that you can submit your questions. In addition, the slide deck, as well as an investment case for QQQA that we're about to talk about, is included as part of the overall panel. Let's move to the results of the poll if we can, to see the output of this. And so strong outperformance is the majority, actually a rules-based approach and consistent sector and style consistency being much more important than low volatility. Kieran, I'm going to bring you into this to offer your take as you then walk your way through your portion of the presentation about the ProShares product. But Kieran, what do you think about the results here?
Yeah, thank you, Todd. Great to be with you. And certainly no surprise on the most popular response there of outperformance. We're all looking, of course, for performance. But the one that strikes me as being interesting is this idea of a rules-based strategy. So I think investors like the idea of knowing how a strategy works, it being transparent, it being simple to understand. And certainly that is one of the things we like to think about when we brought QQQA to the table. So if we could move on to the next slide, please, and get into it. As Todd mentioned, my name is Kieran Kirwan, and I am an investment strategist with ProShares, and I'm going to walk you through how to turn the pretty interesting idea there that Jay went through in terms of the index into an investable opportunity. And we are, of course, very excited. Moving on to the next slide, we're very excited here at ProShares to introduce QQQA. It's our newest ETF offering, and it is, of course, a rules-based strategy there based on the Dorsey Wright index that Jay just described. So a couple of quick highlights, a lot of text on this page. I'll maybe break it down for you. The product came to market in the middle part of May, so we're just over 2 months old, and I will say we've been very encouraged by the interest in not only the product, but of some of the inquiries and some of the promotional activities we've been doing. This is a product and a strategy that has certainly caught a lot of investors' attention, so fantastic news there. It is the only ETF utilizing a momentum strategy based on this Nasdaq-100 index. So we think that's a pretty unique attribute of QQQA. And lastly, and we can maybe focus on this a little bit towards the end, it is in fact the most economical in terms of expenses of Dorsey Wright based ETF products. So if any Dorsey Wright disciples out there in our audience, you will hopefully be pleased to hear that news. So next slide, please. And we will just focus here a little bit on the Nasdaq-100. And of course, we talked about that a little bit in the prior few slides. It is maybe not just an IT and information technology based index. It is perhaps now most recognized as the quintessential or the de facto large cap growth benchmark. And it's certainly billed as one defining today's modern day industrials, I think is what the language they use on their website. It includes many of the names, of course, that you know, Alphabet, Tesla, and Apple. And if you look at the performance here since inception, hasn't been too shabby, of course. And we're showing you that performance relative to the S&P 500. So it does have this idea of a proven history of growth, and it has outperformed the market, if you think of the market as the S&P 500, in 11 of 13 and 9 of the last 10 calendar years. So pretty good stuff there. Next slide, please. Triple QA is in fact a factor-based strategy. So we're utilizing momentum in this situation, which some would profess to be among the most consistent of all factors out there in the factor zoo. And indeed, if you look at its performance over the decades, that's what we're showing you here in the slide there. It has been quite impressive relative, again, to those more broad-based large cap indexes like the S&P 500 or the Russell 1000. Just a note here, we're utilizing the French data to define momentum here, and that, of course, is all publicly available. Next slide, please. Again, a couple of quick words here on the index construction that Jay went through. So it is, as we've talked about, a very rules-based and transparent, simple to understand methodology. Triple QA fully replicates this index, so there's no optimization or anything like that. The breakage from the index will be very, very small. Whatever the index does, the fund will mirror exactly. In terms of the highlights, again, a 21 stock portfolio with the highest momentum, so very compact, equal weighted, which we'll talk about in just a brief moment here, which we think is a really innovative and cool feature of the product. And then we are rebalancing on a quarterly basis. So we do have a bit of dynamic oversight to the portfolio. It is certainly not a set and forget strategy. Next slide, please. Now I'm going to take this opportunity here to kind of drill in on the idea or one of the benefits of the equal weighted approach. And if you think about the Nasdaq-100 index, it is, of course, a market cap weighted index, which means certainly it can get to be a bit or a touch top heavy at certain times. And you know, some folks would argue that the market in and of itself, right, the S&P 500 or even the Russell 1000 indexes, up at the top, the very top of that index, just based on some of the really good performance that many of the largest cap stocks have had, gets to be a little bit top heavy. And you can see, if you were to look at the Nasdaq-100 index, its top 10 holdings right now are over half of the portfolio, somewhere around 53% of the portfolio. That means that the average weight of the remaining 90 stocks in that 100 stock portfolio is very small, in this case, less than 1%. So not likely to move the needle. If you look at what we're doing with respect to triple QA on the right-hand side of this page, we are equally weighting the portfolio. So each of the 21 stocks representing just under 5% is really this nice balance between having a compact portfolio that each and every name can have a meaningful contribution to performance. So that is a very important distinction indeed. Next slide here, and we're going to wrap up soon. In terms of how investors typically utilize this type of portfolio, we really see two primary applications. We think triple QA is a very suitable sleeve in your growth and can really represent your growth equity portion of your equity portfolio on the left-hand side there. Or if maybe you're a core satellite constructionist, having this momentum-based factor approach can be a very nice satellite into whatever you are doing to the core part of your portfolio. The other item I would note here is this idea of style consistency, right? And we say that in the title of the slide. Since the Nasdaq-100 is in fact a growth index, we think the idea of triple QA relative to other momentum strategies will likely be a little bit more style pure, style consistent. And that, of course, is another nice feature. So we're going to wrap it up here, Todd, on the next slide and pass it back to you. Again, some of the fun terms there. Triple QA is, of course, the product. You can see some of the other terms on this slide. So with that, Todd, I will turn it back to you.
Thanks, Kieran. We got a bunch of questions that came in, some that were submitted in advance. So we'll cover some of those, and we're at the mark that we were telling people on. So apologies if we don't get to every question. Kieran, I want to stay with you for the moment because you alluded to it, but people are familiar with momentum ETFs, and there's some other ones from other providers. What are some of the things that make QQQ different from a momentum approach in terms of the universe it invests in, or how you think about this relative to some other more established products?
Yeah, it's a good question, Todd, and certainly you following flows like you do, a lot of the momentum strategies out there in the marketplace tend to be maybe based on more broad-based indexes, right? Like the Russell 1 or the S&P 500. That's certainly one difference. But this idea of equal weighting again is in our view a very unique differentiator. And again, it's a way to think about perhaps hedging some of the concentration risks of some of the more broad-based indexes. And I noted on the last slide this idea of style consistencies. If there are momentum, people being aware with momentum strategies in the marketplace, there were a lot of momentum strategies when they rebalanced earlier in the year that had a pretty dramatic shift in terms of their portfolio from this idea of being growth heavy into a value-based footprint. So, momentum strategies can in fact be whipsawed. We certainly saw from a performance perspective, right, value stocks kind of taking the lead in the first part of this year during Q1. That switched around a little bit in the second part of the year, and more recently, growth stocks have kind of reasserted their dominance and market leadership. And if you're in a strategy that can change its stripes, so to speak, moving from growth to momentum, when you've got a market that's whipsawing like this, it can be a little bit less than ideal. So we think that this idea of having a growth-centric momentum strategy is a very unique differentiator with respect to QQQ.
Thanks, Kieran. I'm going to take one of the questions that came in because we at CFRA are covering many of the so-called FANMAG individual stocks, which would include Amazon, it would include Apple, it would include Microsoft and Netflix that are not part of this ETF, and the advantages of using an ETF relative to those stocks that CFRA either has in a hold or buy recommendation on. This just gets down in part to the benefits of an ETF. So Jay said that people could do this individually, do relative strength on the Nasdaq-100 themselves. If you were to do this yourself, you would certainly be impacted by the tax consequences of selling out of something when the relative strength weakened and buying something when something else improved, and you get the equal weighted exposure through, or the diversification exposure as well through this. So the advantages of an ETF relative to buying individual stocks is multifold, but the diversification and tax consequences are great examples of it. Jay, I have a question for you. We're going to put ourselves through the disclosures for the audience to sit through while I ask you about. Actually, we'll leave it here for a moment, and then we'll come back to the disclosures. Apologies for Jay. You mentioned about a lag to the changes of companies being removed from the index. Do you mind spending another minute or two on it? Tesla being removed recently from the index, it is because it dropped out of the top quartile, right?
Right, exactly. Yeah, when you think about momentum strategies in general, I mean, by definition, they're never going to try and buy stocks at the absolute bottom or sell stocks at the absolute top. But what they're really designed to do is try to capture the big meat of the moves in between and be on the right side of the big trends in the marketplace. And so as a result of that, in order for a stock to move, to fall out of the index, let's start with that, something that's showing a high momentum performance, in order for it to come out, it has to endure a period of underperformance before it falls out of the top half of the rankings. Similarly, in order for a stock to make its way into the index, it has to outperform in order to march its way up the rankings within that index. And so during those periods, during those transition periods, you can see some individual stocks may be underperforming within an index or momentum in general if there's a lot of turnover happening. As the old leadership rotates out and the new leadership's rotating in, you may see a period of underperformance before those new leadership trends can make their way into the portfolio and then accelerate from there. And you know, the way that we think about that and the way that we talk about those transition periods and during those periods of underperformance, they tend to happen in a couple points in time. One, when you have a lot of turnover taking place in the portfolio, and then two, when you have a leader list or trend list type of market. And so, you know, if you think about it for a second, you think about like a manual transmission vehicle and what it takes to shift gears and go through that process. If you're driving in first gear, if you want to go from first gear to second gear, you have to lift your foot off the gas, slow the momentum in the car down momentarily to push in the clutch and then shift up to second gear before you're then able to reaccelerate and move faster into a higher gear. And that's what's happening during those periods, those transition periods within a momentum strategy. During those periods where you get a lot of that turnover, is that's the periods where that old leadership is rotating out and that new leadership is rotating in before those new trends can establish themselves.
Thanks, Shay. And I will do one last question. Kieran, I want to bring this to you in part because of your overall investment strategist perspective, but also because ProShares has a technology dividend ETF, TDV. Triple QA has a meaningful, 40% plus weighting within the technology sector. I think the audience could benefit from hearing just your view on how the fundamentals of the tech sector look. Obviously, they look strong enough from a technical perspective that there's a heavy weighting within this portfolio. But what about the fundamentals from your perspective?
It's interesting, Todd, when you think about it in this context. Of course, Triple QA being a rules-based strategy, the fundamentals, as you mentioned, aren't an explicit part of the process, but just stepping aside for a moment and thinking about it through a fundamental perspective is interesting because a lot of people may not think of, say, the tech sector being associated with quality stocks. And I would tell you that that is absolutely the case. And if you think about kind of the more well-established, mature business models of some of the larger cap tech stocks, they tend to have very little debt. They tend to be generating gobs and gobs of cash. And a lot of that is being returned to shareholders in the form of a dividend, of course. But even if you look at kind of the quality metrics, higher quality than the overall market is the tech sector writ large now. And that is something that certainly wasn't the case in the recent past. So certainly number one is quality. Number two, I would say, is this idea of earnings and margin. So if you're following earnings seasons, the headliner there that you need to take away is that companies are absolutely obliterating earnings expectations. And the earnings expectations that are coming in keep exceeding even very optimistic expectations. And of course, tech is at the leading edge of those from a sector perspective. So very, very strong earnings, and margins have been improving as well. And the one sector that's improved its margin the most over the last year is none other than the tech sector. So I would tell you that this idea of blending a rules-based, quantitative momentum-based strategy with an index that is heavily concentrated in the tech sector, which has, of course, very strong fundamentals, makes for a very compelling opportunity right now.
Well, I would agree as well. We at CFRA are covering a wide array of technology stocks and reiterating strong buy recommendations throughout earnings season on many of them. We'll move to the next slide. Apologies for doing that earlier. On the right-hand side, if folks are new to CFRA and you're not using MarketScope Advisor, that's our platform that many of our clients are consuming our stock and our ETF research, as well as the thematic commentary that we've touched on. The left-hand side is a teaser of an upcoming webinar that we're doing in August. There'll be more details available. You can visit our website that's at the bottom of the screen that has a list of our events and webinars as well. I'm going to move us through the next slides, which is, I believe now, how you can learn more about ProShares. We'll move one more slide, and I believe now we're going to get to the disclosures and disclaimers. I'm going to use this as an opportunity to thank Jay, to thank Kieran, to thank the audience for being a part of this. There'll be a survey that's going to pop up. We'd love your feedback and how we can make more of these ETF-oriented events more conducive to your needs. Thank you for your time, and thanks for your confidence in CFRA to learn more about the ETF marketplace. Have a wonderful day.